Hi everyone, welcome back to our channel Windfall Returns. In today's video, we are going to discuss about the India's GDP data which was released on last Friday. And this data is for the second quarter of the current financial year. Speaking in terms of number, the forecast on polls were 6.5%, while RBI had a forecast of 6.8%. But the actual numbers came in at 5.4%, which is the lowest of the past 7 quarters. So if we see who is the biggest fall player of this disappointing numbers, it is the manufacturing sector. This heavy fall in GDP will subsequently trigger the policymakers of RBI to decide on the interest rate cut in the upcoming months. The next RBI meet is going to be held on December 5th and 6th. One interesting thing to note down here is the government capex spending, which is considered as a catalyst for economic growth. This capex spending of the government has reduced by 10% in the second quarter of the current financial year. Earlier, analysts from Goldman Sachs to Barclays had a GDP forecast of 6.5% for the remaining quarters of the current financial year, but now they have rushed to downgrade the forecast to 6%. Now coming to the point, let's see how these numbers are going to affect the Indian market. So this fall in GDP will create a short-term setback. Nifty at current levels of 24,000 may fall to test and may even break 23,000 levels in the coming days. Bulls may have to stay away since bears will take control of the market to scale it down. Speaking in terms of price action, from October, Nifty has started to trend lower with lower highs and lower lows. This trend seems to continue further down until the release of GDP numbers of third quarters. So this is going to be a bear market, but still there are few factors which will affect the bears. This includes the outcome of RBI MPC policy meet, which is going to be held on December 5th and 6th, where policymakers have to weigh in between the inflation pressure and GDP numbers. Also, if government capex spending gets improved, this may boost the manufacturing sector and improve the GDP numbers of the next quarter. The tightened monetary conditions may also be loosened by easing the cash reserve ratio from the current levels of 4.5%. This might have many positive impacts like boosting the economy, improving the urban spending and infusing capital in the economy, ultimately improving the GDP numbers. But we cannot expect all these factors to come into rescue immediately. The impact can be felt slowly and can be seen only in the release of next quarter GDP numbers. Until then, Nifty testing below the levels of 23,000 cannot be ruled out in short term. Stay tuned with Windfall Returns for more market updates.